All right, it looks like audio is connected for most everybody, so good evening, welcome back. My name's Misty Rusk, and this is the San Diego Angel Conference for eTrack Session 7. Super great to have you here tonight. So we're doing valuation cap tables and term sheets, which is one of those things that's really tough to wrap your head around. And if you get it wrong at this stage, it can really cause a lot of harm in the long run. So super excited to have a great speaker with us here tonight. I'll introduce her in just a minute. And we've got a couple of other things lined up for you as well. So follow up from last week, you got some feedback on our Show Me the Money session, and I've got another set of tools to share with you tonight, and excited to get started. So we'll get right into it. Just wanted to remind you, the San Diego Angel Conference is part of the School of Business's Free Enterprise Institute at University of San Diego. This program is supported by the university and in partnership with the Brink SBDC, sister organization to the San Diego Angel Conference, that offers free confidential consulting services to scaling innovative companies like yours. On the line right now, we have Rhoda Sabachi. So she's the program manager. Maybe don't have that right.
Program specialist.
Program specialist.
It's like kind of the same thing, yeah.
for the Brink. Rhoda, do you have anything you'd like to share?
Yeah, so like Misty said, we're the Brink Small Business Development Center at the University of San Diego. We're one of 9 specialty centers in San Diego that help small businesses get resources and one-on-one consulting and access to training events as well. But yeah, if you aren't a client already, I'm going to go ahead and put the link to our website where you can sign up. And if you have any questions, feel free to email us. I'll also put that in the chat as well.
Perfect. And if she's sending you the website, any page of that site is going to have a big blue button that says register for services here, or sign up, or has something that indicates how you get in touch with them. And those services are underwritten by Small Business Administration, City and County of San Diego, GoBiz from the governor's office, and some individual donors as well. So we're always glad to help support the Brink, and the Brink turns around and helps to support San Diego Angel Conference and helping get the companies ready for the big show. We also have, as part of our group, the Catalyzer and other student-focused activities. And I see Diana Nash-Hags on the line with us tonight. Diana is the Student Success. I'm going to learn her title. It's the important point that you want to know about Diana is we're catching some feedback from somebody. Somebody's got me on twice, I think. The important thing that you want to know about Diana is that it is her job to help students be successful in innovation and entrepreneurship, and she will be actively looking for opportunities to shadow for different roles. She'll be looking for placements for interns. She will be the person who knows the most about our students. And so if you're looking for ways to give young people experience while you also get some benefits of having some extra help, Diana should be your go-to. Diana, I don't know if you're in a position where you can turn your mic on, or if you have anything you want to share tonight.
Hi, no, I think that was well put, Misty. Thank you so much. I have been reaching out with a few individuals and posting internship opportunities, connecting students with industry professionals, and also just promoting a lot of opportunities for our students to engage and learn from our more experienced entrepreneurs.
So thank you for that. So we've got one of the best finance programs in the country. We're a top 25 rated entrepreneurship school. So if you needed those kinds of supports, we have great marketing programs. And one thing you might not know about some of the options we have at USC is we have a business data analytics program. So if you needed somebody to take a hard look at a big data problem that you're looking at, we've got a whole team of students in a new program that can help do that. Applications are open. I do know that it's working. I've seen 2 applications come through, so we're super excited about that. The application fee is $149. It's non-refundable. So if you get cut in the first round and you call me up and you say you want your money back, I'm not going to give it to you. I am going to give you a ticket to the main event, and your information is going to stay with those investors. So I was actually on the phone with one of our SDAC 2 and SDAC 3 investors earlier today, and he wanted to let me know that he had made 3 investments with companies that came through our process that didn't make it to the semis, the quarters, or the finals. But he remembered seeing them, went back and took a closer look, and wanted to make an investment in those companies. So even if you get cut in the first round, we know that that's not the end of the line. It's just one more step in the process. This is what the website looks like. So if you don't know how to start on the application, go to thesdangels.com and you can go to /apply and that will get you to the page that has the application button. It's right underneath the countdown. So this countdown's now a couple weeks old. The apply button's right there, and you should be able to, that's going to take you over to Gust, and that's the platform that we use to manage our applications. We also couldn't do this if we didn't have some sponsors coming in to underwrite. So we are really grateful to have NextWork, which is a local San Diego company that does outsourced software development and can do all kinds of specialty things. So if you need to build an app or you need a website, this is a group that would like to be top of mind for you. And so we would like for you to take a look at their materials. And if you have those needs, at least give them a shot. That would be our special request. And we could not do this without the partners. So this is probably one of the more significant things that's part of the San Diego Angel Conference. There's a fantastic group of organizations here in San Diego that are doing all kinds of work to help move the ecosystem forward and support thousands of small companies become much bigger companies. So this is our great group. They help us with investors, they help us with social media, and they help us with entrepreneurs. So the Brink is one option for you. There's probably a half a dozen of these listed here, maybe closer to a dozen that have specialty support services for different industries. We're happy to help you make those connections if you need to get to know anybody at one of those places. And so we've been talking about this now. This is week 7. We've been talking about this now, and I thought tonight would be a good opportunity to step in and talk to you a little bit about a little bit more about what the real process is going to look like. So we spend this whole fall building, I love funnels, so I use them a lot. So we spent the whole fall trying to find the right companies to put into the funnel and hoping that at the end of the day, we get some really good quality deals that come out of it through this process. So if you came in and you were already ready to go and you maybe even raised some money, maybe there's something that we could help you sharpen up on. Or maybe it's just people hear about this and then that leads them to the application process because you don't have to participate in eTrack to apply for the San Diego Angel Conference. It's just a resource that we offer. At the end of that process in December the 15th, that's the application deadline. And then we take all of those applications and we dump them into the top of the next funnel. So that next funnel, what we're going to do is we're going to break the investors into groups. And every investor is going to look at probably, depending on how many deals we get, every investor is going to look at probably 20 to 25% of the deals that come through. And then they're going to work in groups to sort out the total number of applicants down to, we hope to get to top 24. I think if we can get to the top 30 this year, we're going to be lucky because it looks like we could have a really great group of applicants this year. So our first round of cuts is going to be totally based on what we see in Gust. So we really want you to do a video and make that application as complete as you can so that we have a chance to get to know your companies, because we're not in a position where we could bring in all 100 or 150 companies to be able to have a personal interaction. So from there, we're going to take the 24 quarterfinalists, And we're going to bring them in for a 3-minute pitch with slides and a short moderated Q&A. And we're going to see all of the deals over the course of 2 evenings. And then the investors are going to vote again. And they're going to vote for the top 12. So we're going to bring the top 12 companies in for a full 10-minute pitch and a thorough Q&A before they then select down to the top 6. And when we get to the top 6, we're going to invite those top 6 companies to come have dinner. So our investors are going to break into 6 teams. Each team's going to take 1 company, and they're going to spend that first night 2 or 3 hours having dinner, getting to know the founder, starting to do a deeper dive, and handing off a list of questions. And then we're going to spend 5 or 6 weeks in what we would consider pretty thorough due diligence process. And every week, the teams are going to report to each other their findings. So they'll say, hey, we're working on company A, and we discovered these things, and we're really excited about this stuff. And now we have these new questions that we need to have answered. And we've reviewed the financials. Somebody's looked at the legal documents, right? So there's some version of that happens every week for 5 or 6 weeks, right up to the day of the conference, which we think now will be March the 24th. So we think we've got a location set, and I would say that's a much stronger tentative than what we've talked about before. When we get to the main event, we're going to hear those companies pitch one more time. And then the investors are going to be sequestered until they choose a winner. And during that whole time, each of the investors is putting in some money. They're each purchasing units in the fund. The winning company will walk away with what we anticipate will be at least $200,000. And we hope that there will be some runner-ups that are funded as well. So our goal is to get to 200,000. We've always exceeded that by at least 2x. Last year by 3.5x. Which was fantastic. And then last year we were able to fund the top 5 companies. So winning company walked away with 295,000. The 4 runner-ups got investments that were over 100,000. So I think 106.5 is what it came out to for the runner-ups. And then each of those companies, we negotiated the terms with each of those companies in the due diligence process. So we're not looking to do a Sharky type deal. But we are assessing for a fair and reasonable deal with a full expectation of return. And if one of you could be a unicorn, that would be super exciting for us. So we would all like that very much. Before I go on, are there any questions on process? This is probably only the second time I've really laid it out.
So, sorry, you said in uniform? I think I missed that.
In uniform.
Yeah, maybe I misunderstood you said.
Oh,
Okay.
a unicorn. A unicorn.
Oh, a unicorn.
Sorry.
Yes, unicorn.
Thank you.
If one of you could come in and be valued at $1 billion or more, we would be very, very excited for you. And
yeah, but yes, much more excited about unicorn than uniform. I was like, what? So thank you.
all right. This is the same group that you've seen before, but I just brought their pictures to you a different way. So fund managers for this year are Brian Pullman and Sumner Webster. Brian's on the call. I'm not sure if Sumner is in and out. He's been traveling a lot. So Brian, do you have anything you'd want to share?
Well, I've said it for 7 straight weeks now. It's great to see, well, 6 straight weeks. Great to see so many people back, and I'm always seeing new faces. We're really happy to be able to provide this part of the experience for everybody and try and bring you kind of deep dives into different parts of what it takes to be a successful startup and what we as investors are going to be looking for. The one thing that I want to emphasize to everybody, underlying or maybe laying on top of all of those should always be networking, right? So we have the breakout rooms at the end. Even though we don't necessarily have our full fund management team here every night, we have this little secret, this thing called LinkedIn. So you can look us up and you can reach out to us. We just met with a couple of the other San Diego Angel Conference investors, and it's amazing to me how well connected this group is. So if you need an introduction and you see that this person's connected, don't hesitate to reach out to somebody else who might be an SDAC investor. And I'll just leave it at that. Thanks, Misty.
Yeah, so Brian and Sumner this year are supported by the fund managers from SDAC 1, 2, and 3. That's Dr. Sylvia Ma, Benton Moore, and Amy Duncan, in addition to 4 others: Tammy Stevenson, Jad Duncan, Richard Lynn, and David Lowski. And then, of course, as staff, you've got Chris. Chris, I'd never give you an opportunity to say anything. Would you like to share? Like how
on the spot, I have no
all the
idea.
time?
He thanks you for that, Misty.
Go ahead, Chris.
Oh, no, I have nothing to say on the spot, unfortunately, Misty.
So,
But I will at least say that, if you ever have any questions, feel free to reach out to me directly. I'll get the emails whenever you send something to either fei@sandiego.edu or info@thesdangels.com. But really don't hesitate to reach out with any questions.
yeah, so Chris and I are the staff for this program. We're supported by some others at USD, and happy to be able to be a part of this again this year. Our speaker for tonight is Catherine Edmonds. Catherine is an attorney that came to me by a long circuitous route, and turns out she's right here in San Diego. So we're very excited to have Catherine Edmonds here with us tonight. She is a corporate and securities attorney and has a lot of experience in this area. So with that, I will stop sharing, and Catherine, I'll turn it over to you.
Okay, I'm going to share my screen. Let's see. I don't know what happened. Did it share? It did.
Yes.
Hi, everybody.
yes, we can
Thanks,
see it.
Misty. I'm really excited to be here. I do live in San Diego. I moved here just as the pandemic was starting in March 2020. Can you see my screen? Great. So I have over 13 years of experience in advising companies, entrepreneurs, etc., in basically all aspects of corporate law. And I'm really excited to be here with you all, because one of the things that I love most about my practice is I love sharing my knowledge with others. And I feel like the more knowledge that you have, the better you'll fare in the future. And that's kind of what this presentation is about today. I have some fun facts. The largest venture capital deal that I worked on was representing an investor in a $300 million investment in Twitter. And it was when Twitter was a tiny little private baby company, and they just had the normal venture capital investment documents, but a huge valuation. And so when I get to talk about factors that investors look at to determine valuation, I can kind of say how they got to that 300 million valuation. And it worked out for the investor, because about 2 years after that deal, Twitter went public in an IPO, and they definitely made money off of that transaction. I also have a fun fact. So I already said when I moved to San Diego, my next fun fact is I have 2 kids. So if you hear any kid noises, I think grandma has it under control, and I moved here because my family was in San Diego, although you can tell from the diplomas in the back maybe that I'm an East Coast native, UVA undergrad and UVA law. But I'm here in San Diego to stay. My family retired here. My brother married a San Diego girl. So I'm super excited to be connected with Misty. So just a quick kind of focus of where this presentation is going. And it's to set your business up for success, because if you put in place the proper building blocks now, then when you do get to the point of that venture capital financing deal structure, you'll have everything in place so that you can succeed. So we're going to work within that financing deal structure, understanding that many of the people in this group are at the angel investment stage. But I'm going to walk you through an example later on in the presentation that kind of plays out how some of those convertible note instruments and some of those safes convert in kind of like your first seed round or your first, priced A round, and where the terms in those ultimately affects how that price round works. So we'll focus on key factors as how venture capital investors, what they use to value your company. We'll understand the capitalization table and the venture capital term sheet. And we're going to get pretty technical. I mean, we're going to dive right in there. So, I mean, hopefully everybody's ready for that. And then at the end, you'll understand how the early decisions really affect your later rounds of financing. So I have a polling question for you all. Chris, can you bring up the poll? So what would your ideal business exit strategy be? An IPO, sale of assets, merger? It kind of seems weird to think about this at the beginning, but it's often good to go in at the start with the end goal in mind. Oh wait, responses are coming in. Sale of assets to a strategic acquirer is winning as of right now. Second is IPO. We have about 20 votes remaining. Well, we've got a majority participating. So it looks like A, B, and C were the favored responses. Not as many people liked D. And that's good because a venture capital financing and that type of investment works very well for those A, B, and C, IPO, sale of assets, merger, exits. And those are actually what venture capitalists are primarily looking for. The management or employee buyout would be if you want to keep the company closely held and you have to really monitor the engagement of investors and bootstrap. Moving forward. All right, so we can talk briefly about the roadmap to the VC deal. And so where probably most of the founders on this call is in the friends and family stage. At this stage, you also have the ability to get convertible note investments and safes, and I'll just touch base on those a little bit. You could do convertible notes and safes at any point in time to bridge between rounds of financing if the company really needs capital to keep going. Talking briefly about convertible notes, that's a debt instrument and it's going to bear interest. It's going to convert in the next price round, and basically there'll be a qualified financing, so it'll be an amount you have to raise over a certain amount of money. But there's a lot of variables. You could have optional conversion. I mean, a lot of these documents, they're choose your own adventures, right? They have different variables that you fill out and fill in, and some of those variables end up being more investor friendly, and some of them end up being more company friendly. Convertible notes generally convert at a discount or a valuation cap. The valuation cap minimizes risk a little bit because it won't convert at the valuation cap unless you raise over that much money in the next round. The discount is usually like, it's 80% of the next price round would be the price of the securities that they get for their convertible note investment. And at maturity, convertible notes can generally be structured to convert at the valuation cap or be repaid with interest. Safes are a little bit different, and safes are very trendy right now. They're becoming increasingly popular. And the difference between safes and convertible notes is that safes are not a debt instrument. They have no maturity date and they don't pay any interest. Basically, they're writing a check so that they have the right to purchase the amount of which they wrote their check for in a future round. Safes can purchase those shares at a discount similar to the convertible notes, and they can purchase at a valuation cap. They can have the option of if they get more shares under the discount or more shares under the valuation cap, or they could just get the next price round and not have the discount or the valuation. So those instruments can be used at the very beginning. And as you'll see later on, those terms come into play in your priced rounds later on. So it's very important to negotiate early. There's also angel investment. Angel investment can happen at any point in time. It's generally in the earlier stages. More sizable investment than friends and family, can offer network connections, strategic opportunities, as I say there. You guys are pretty familiar with angel investing because you're here. Moving on, seed is generally the first price round. It's smaller in size than your Series A round. Sometimes it has a less robust term sheet. It's more flexible. The intention of the seed round is to support beta testing, fine-tuning the company's business model. The investors in the seed round generally have a different outlook than, okay, we want to make sure that we exit in 5 or 10 years, which is sometimes what you're finding in your A's and beyond. So the Series A and beyond, you generally have higher valuations for a higher investment. You get venture capital firms that typically seek more robust and protected deal terms. And they can also provide advisory services and strategic assistance as well. And they generally have, well, we'll go through a lot of the preferred terms that you would see in a term sheet later on. So polling question 2. When you think about accepting venture capital financing, what are you most concerned about, or what? Yeah, so I'm interested to see what this group is going to say. Okay, 55% is in. We have mostly finding an investor that's like-minded, that can serve in an advisory capacity, and then also maintaining a certain level of ownership and control. This group is going to love Misty's presentation after, because she's going to go into how to maintain that. Oh, 74 participated. Good job, guys. So the winning one with 50% is finding an investor that's like-minded and can serve in an advisory capacity. I think all of these things are important. But I think that you guys have the right mindset, and you want to have an investor that can be a future partner. And especially at early stage with maybe your first round, you definitely need someone that can help you scale, that can help you achieve your strategic objectives, and that can add value, not just the investment amount. So that's good. You guys are thinking correctly. All right. Okay, moving on. Stop. Okay, so I know nobody really thought that valuation was the first thing that they were concerned about in that prior slide, but the name of this presentation is valuation, term sheet, capitalization table. So first of all, we need to talk about valuation. Valuation, there are lots of different ways to calculate it. Basically, the valuation of your company is the amount that an investor is willing to pay for it. So it's important to focus on factors that investors use to determine the valuation. One of the main factors is traction. And this is where really the Twitter example. I mean, at that point, Twitter was still a small private company, but they had a large number of users. They were worldwide, not just nationwide, they were worldwide. And they had a lot of publicity. They had celebrities that were using their tool and things like that. So, I mean, I knew what Twitter was, and I was surprised when I was doing some of the diligence on it that they just had these ordinary plain Jane investment documents. And I was like, whoa. So traction is really important. And as I'm highlighting these are things that you can keep in mind. Like if you don't quite feel you're there yet, these can give you ideas of where you need to kind of like buff up, you know, or if you're already there and you're marketing yourself to investors, then you can really like use these to sell your company and sell what you're doing well, sell your strengths. So traction, have you been able to grow efficiently? Like how have you handled prior investments? Have you burned it through crazy bills? Have you been effective in using your funds that you've devoted towards marketing? I mean, have you established all of this stuff showing that you're prudent, that you're a good manager of your company's funds? Management is another key thing. Investors love serial founders with experience. You know, you can point to, oh, I got this company going. I know what I'm doing. If you don't have that, maybe you'll think about bringing someone on that does have the serial, entrepreneurial experience. And also diversity of skills. If, you want to make sure that you have a wide variety of skill sets that you can pitch to investors so that you've got basically every base covered. Commitment of the management team. Are you part-time? Do you have another interest? Economy, there's not much you could do about that. Investors look to the value of other comparable companies in the current economic climate. And then this is kind of my favorite one. And this was a Twitter special sauce too. I mean, like, is your product, technology, market opportunity, industry, are you hot right now? Do you have the special sauce that's attracting not only this investor, but attracting another investor? If you don't have the special sauce, what can you do to kind of vary your metrics, vary your margins, increase those margins, and generate some special sauce? So that's then let's see the next slide. So then I'm an attorney. So there's pitfalls to avoid in valuation. And so you want to get the right valuation. There could be the compulsion to like really overvalue your company, but that might have the following pitfalls, which is difficulty improving growth in later rounds, because you always want to have that upward trajectory. When you're pitching, you want to have that graph going up and to the right. That's what every investor wants to see. You might have difficulty meeting milestones. And then there's potential for down rounds where the business value is below the value of the prior round. And if you take on preferred investors, they're going to have anti-dilution protections if you have a down round. So primarily the bearer of the brunt of the down round is going to be the founders and the common stockholders. You don't want to undervalue your company because you would lose a lot of equity. You have less equity to offer to future investors as your value is diluted. And if you need additional investment to grow your business at the proper pace, it's tough because you don't have the amount of capital, or the pieces of the pie have already been apportioned. And it's tough to get that pie larger when they're already been passed out. So does anybody have questions on valuation?
Yes, we have a couple of questions here. So first, I'd like to know if investors consider the coachability of the founder, and if yes, how much is it important?
I would think that investors want a founder that's coachable. I think that one of the things that investors learn early on is that it's important for the founder to be flexible. I've seen companies that change their business model 5 or 6 times before they find something that sticks. And I think definitely a coachable, flexible, committed, business person would be great.
Thank you. Second question is, was Twitter's special sauce just that they had celebrities using it and talking about it?
I'm not exactly sure. I mean, it definitely had a lot of hype. It was something new. People seem to really enjoy. I mean, everybody enjoys being the expert at something. It gave people a place to just shout out their opinion and have other people follow them. And this was even before Instagram and things like that. So I don't know. I mean, this was several years ago, but it was so hot, and it still is. I'm not a huge Twitter person, but people still love it.
Thank you. I think we just got a couple more in. Convertible notes, is there a valuation involved at that time or later?
Evaluation what?
The question was convertible notes. Is there a valuation involved at that time or later?
Yes, you typically have a valuation at which a valuation cap at which the convertible note will convert, and that is in the note, not later on.
Catherine, Can you explain that a little more? So let's say it's 20% discount at a 5 million. They'll say something about a 5 million valuation. What does the 5 million valuation mean? Does that mean that's the max or min?
So the discount and the valuation cap are separate calculations. Yeah. So the discount, so basically the convertible note is going to convert at the next round of financing. So the next round of financing, that new investor at the next round of financing will have a price per share. And I'll talk later on about how that price per share is calculated. The discount is the discount that convertible note will have based on that price per share. So if you have, 80% of that price per share, the share is $1, you pay 80 cents a share. And then you basically have the value of the note. So you have like a $15 million or $10 million note, and you get that many shares that 80 cents per share buys. If you have the valuation cap, then you have, you convert at a amount that's over a certain amount. So you have 5 million. Let's say that the valuation cap is 5 million. So you would do 5 million divided by the fully diluted capitalization of the company. And that would get your price per share under that conversion. So it's two different calculations. And oftentimes it's whichever one gets the note holder the most shares. So you'd have two different price per share calculations. And that's in my slides later on, and I'll go over that in depth.
Thank you.
All right, there are some questions flowing in. I have a feeling you're going to get to some of them.
Yeah, I'll move in because I think, because I'm going to talk about this more later on. So let's keep moving. All right, so you have an idea of what your valuation of your company is. Next step is the term sheet. And this is a huge practice pointer. The term sheet will serve as instructions for how your financing documents will ultimately be drafted. And therefore, the term sheet stage is the time to negotiate and negotiate hard. Some people are like, oh, well, I signed it. It's a non-binding term sheet. You wouldn't believe how many times, you have the non-binding term sheet, but then the other side says, well, you signed it. It's in the term sheet. It's tough stepping back from that. So really make sure the term sheet includes all, your best effort at the terms you want. Obviously, there's going to be more negotiations going down the road, but the term sheet is providing basically the plan, the map for all the documents. So that's the time. And I have some resources here. NBCA.org has model term sheet, model legal documents. SeriesC.com has slightly different model documents, but both are great resources. So in a preferred stock financing, of course, the investor is investing and they're going to get preferred shares, which basically have a preference to common stock when a liquidation happens. There's other preferred terms as well that protect the investor with those preferred stock. So I'll go over later in the presentation some of the most common preferences of the preferred stock, but basically that's what you're buying. You're buying a preferred security. As opposed to common, you get paid out earlier. Another term is the amount raised. What amount is going to be raised in this financing? And here's where the convertibles can come in. So if the company has a lot of notes, safes, etc., and you hit that valuation cap where all these things are going to be convertible, they're going to participate in the round and they're going to be included in that round because they're already outstanding. And that's why you want to make sure that you have decent terms in those prior documents. So we talked about valuation, and another one of the terms, of course, is the price per share. And valuation, specifically the pre-money valuation, informs the price per share in the venture capital financing. So the pre-money valuation divided by the pre-money shares outstanding equals the price per share. One really interesting thing to note is that the number of shares outstanding is negotiated. And I feel like a lot of founders and a lot of people don't understand. They're like, well, that's the number of shares outstanding. How is it negotiated? investors want the highest denominator, that highest pre-money shares outstanding. So they're going to want to include increases to the option pool. They're going to want to include every convertible securities, every single type of share that they can include. Founders want a lower denominator, less pre-money shares outstanding, because they'll have less dilution. So this is a place where a founder can really effectively negotiate on that definition of pre-money shares outstanding, which is also the fully diluted capitalization of the company. And this is the same term that I previously talked about, which should be negotiated favorably in your convertible notes, because the definition of that fully diluted capitalization that you're using with that valuation cap equation, if it's a huge fully diluted capitalization, which includes an increase to your option pool, which includes all other convertibles, the investors are going to get a much bigger piece of the pie for the same money and ultimately own more of the company. So let's just look at definitions in the term sheet and the cap table. So you have your authorized number of shares. So you have multiple classes of shares. First of all, the company will have common stock. The authorized number of common stock is the amount of shares that the company can issue up to that amount. And this is included in your formation documents, in your charter. So generally, pre-deal, the company will have an authorized amount of common stock. They need to authorize additional classes of preferred stock. And if it's convertible preferred stock, then they need to increase their number of authorized common, because obviously those things are going to have to convert into something, and you want to make sure that you have room under that authorized common. So this is part of the term sheet, and this is part of the deal documents in the financing that the board of directors and the stockholders have to approve the new classes of securities, the preferred securities that will be issued in the venture capital financing, and the increase to the authorized number of common shares that will allow for the potential conversion of those preferred shares if they are convertible preferred. So that's the authorized, that's the total number of shares that the company can issue without having to amend their certificate of incorporation or their articles of incorporation. The issued and outstanding is the number of shares of capital stock that have been issued to stockholders that are currently owned. So this is going to be less than it can be equal to your authorized number, or it can be less than, it can never be more. And then here's the concept of the fully diluted capitalization. And we've talked about this before, and how, this can be a negotiated point. It typically includes, all of your outstanding common stock, outstanding preferred stock, options, warrants, restricted stock, options reserved under an option pool for future grant. And it might also include an option pool increase in connection with the financing and other convertible instruments that will be converted in the financing. And investors are going to argue that since these two events are happening in connection with the financing, that their ultimate price per share calculation should include these shares. Founders are going to argue, no, that hasn't happened yet. That won't happen until we have the investment come in. Those should be excluded. And this is a point of contention, but it's important to try to do what you can in terms of this. And oftentimes the term sheet will have an initial cap table, and it will have a pro forma cap table attached to the term sheet. Whenever I see that, the first thing I do is I ask for, can I get the Excel file? I want the Excel file so I can see the calculations on exactly how each of the numbers in that term sheet are calculated, so that I can ensure that everything is calculated correctly. And then move on from there and negotiate from there. So you're negotiating the term sheet, you're also negotiating that pro forma cap table. So we'll take a closer look. So this is my kind of dummy initial capitalization table that I made. And so here's what we kind of talked about before. We have the authorized stock, and then we have the shares issued and outstanding. We have your options, and generally, this is a little low for an option plan, but I just took a client that I had. The option plan is usually 15 to 20% of the fully diluted shares. And of that option, about 3 to 5% are reserved for a non-CEO founder that comes on. About 3 to 5% are reserved for issuance to the executive team. And then the rest of the option plan is for, salespeople, marketing, product development, to incentivize individuals to stick with the company. So this looks pretty easy, right? I mean, okay, we have the fully diluted shares, right? That's all easy. Well, this particular spreadsheet had several other worksheets which included convertibles. So let's look at the pro forma that ended up for this deal. Well, so we had, what they typically do is we'll set it up so that you have the preferred security, which in this case is the Series Seed, and all of that security has the same preferences. The only thing that is different in the security is the price per share. And the price per share is determined by the terms of those notes, the safe, and your pre-money calculation. So this was a pretty good, it's pretty investor friendly in terms of just the new money price, because it didn't include an increase to the stock plan. It didn't include the convertibles. It just included, that number, or it just included the pre-money, that number divided by the pre-money valuation. It was pretty straightforward, and it was the pre-money valuation divided by these issued and outstanding right here. So that was the new money price. Then we had to go through, we had 3 different tranches of notes, which all had different conversion terms. And we had a safe. The safe was easy because it was not at discount and it was not valuation cap. It just got the price per share of the new money. However, these other tranches, we had to calculate based on those calculations that I stated before and the terms of those notes, what the price per share would be if it was under the valuation cap or it was under the discount. And these holders get whichever price gets the more of the company. So here for these 2017 notes, the price per share that they got ended up being at the valuation cap. 19 and 20 ended up being at the discount. And then we used those to calculate the total shares in each of these tranches. And here is the final closing table. You have authorized, you've authorized all of these different classes of Series Seed because they all have different prices per share. They have original issue price that's different. You have your shares outstanding. As you can see before, the common stock was at 10 million. So we had to increase that to 15 million to get so that we had enough authorized common stock for the potential conversion of all of these preferred. And as you can see for the Series Seed 1, which was the new money, they didn't max out the round. So they had a few follow-on investments to max out this round. And then they did not increase the stock plan, which is unusual because the stock plan is only now 7% of the company. So are there any questions on that? I know that was a lot.
Not a single question. No, there are a bunch. There are a ton, and I'm sure there are going to be a lot of follow-on questions as well.
I don't know how I am doing on time for my presentation. If we should hit those now or if we should hit them, I don't know. Should I keep going? Should I hit the questions?
It's your presentation, your choice.
Sure, let's hit a few. Let's see where the questions are.
All right. Do you see scenarios pre-financing of any kind that the founders don't own all the authorized shares?
Yes, I see scenarios where the founders don't own all the authorized shares, where they've gotten friends and family investment and things like that. Yes, that happens all the time.
And also request if you'd be able to share a link to a sample Excel term sheet by chance.
Possibly, I'll think about that.
All
I'd
right.
have to, it's difficult because it's like about probably like 6 or 7 worksheets. And if I change one of them, then you start getting error codes and I want to de-identify it. So I might not be able to do that because I don't want to share, like my client's information, but I will think about that. I'll try to do it.
All right. Well, thank you for considering it. Could you run through the typical percent of diluted shares for different roles one more time, like 3 to 5 executive team, options include 15%, so on and so forth?
Yeah, so typically the stock plan will be between 15 to 20% of the total fully diluted capitalization. Typically 3 to 5% is reserved for incentivizing a non-founder CEO that comes on board. 3 to 5% is reserved for the other members of the executive team. And the rest of the, the plan is basically small percentages to incentivize typically your salespeople, your product development, marketing, stuff like that.
And a follow-on question for that was, do those change at different phases, i.e. making it to Series A and beyond?
No, they don't. I mean, the stock plan can always be increased if, more is needed. That stays fairly constant.
Thank you. And it looks like some people are starting to share some sites, but if you have some good summary sites or resources to learn about this stuff, that'd be welcome. I know you shared some information earlier. And yes, there will be a copy and a recording of this. So like to get those percents and things, you can, rewatch the presentation.
Those are great. I'm glad people are sharing resources. That's great.
And then one last question, and then get back to the presentation. If you start the company with common stock to 3 founders, 3 million shares out of 10 million authorized, do you always go to preferred stock routes?
What was the question? Do you always go to?
If you start the company with common stock to 3 founders, 3 million shares out of 10 million authorized, do you always go to preferred stock routes?
Venture capital investors want preferred stock. You might have other types of investors, maybe angel investors or family offices or something that will take common, but venture capital, they always want preferred stock. And that's actually the next portion where I'm going to talk about those preferences that are involved in the preferred stock and why they want it.
Fantastic. Thank you.
All right. So the terms of the preferred security. So you have a liquidation preference. And basically, preferred stockholders get their preference before common. And this is why the investors want this liquidation preference. And I think I'm running a little bit short on time. So you guys will get these slides at the end, but there's non-participating preferred where it doesn't participate with common. There's participating where it receives its preference. And then it again participates in the balance of the proceeds that are distributed to common stock on a pro rata basis. And then there's participating preferred with a cap. And also each of the above preferences can include accruing dividends, adding an interest rate component to the preference. The preferred stockholders always want a preferred director. On average, venture capitalists receive a board seat 43.9% of the time. So part of their protective provisions is they have their board seat and then they have a board vote. Here's some practice pointers. Keep the board small. Startup boards typically need to meet often, as many judgment calls and transactions require approval of the board from a corporate governance standpoint, simply because the size of the company is so small. Additional rounds will add additional directors. And keeping the board small just really now allows for that speed and nimble decision-making that's often required in the startup space. And as I said before, oftentimes startups change their business model, they change their focus, they need to be flexible. That's really a key. Another practice pointer, keep the number of directors at an odd number. This prevents deadlocks, improves efficiency of decision-making. Preferred securities generally have voting rights in the form of negative covenants. So these are protected provisions which require consent of a preferred director or a class of preferred stockholders. And negative covenants typically include affecting a deemed liquidation event. So this will be defined in the term sheet, and it's typically a merger, a sale of all assets, a decision to wind down, and basically the preferred stockholders would have to approve this. They'd have to approve altering the charter, the bylaws. The bylaws you provide a lot of the voting and the stockholder, and basically they provide a roadmap for how the company will be operated. The charter has all of the preferred terms. It has everything affecting stockholders and all the rights and preferences and privileges of stockholders have to be in the charter. So amending either of those needs investor approval. And of course, creating new classes of securities. Investors wouldn't want you to create a class of securities that has preferences better than theirs without their buy-in. This is a kind of a new evolving issue, is issuing blockchain assets or digital tokens. This is in the new model documents. In my understanding, which I'm not an expert on this at all, you can have blockchain assets or digital tokens, which kind of mirror shareholder rights in a company. So again, investors are looking out for that. They don't want anything that mirrors a shareholder right. Purchasing or redeeming any capital stock, amending your equity compensation plan, authorizing debts beyond a certain amount, creating a non-wholly owned subsidiary, because the fear is you create the non-wholly owned subsidiary, a portion of the stockholders own that, or it's owned with another company. And all the assets go into there. Obviously the assets could walk away from the company. Dispose of a subsidiary, stock or assets, or increase or decrease the authorized number of directors, because obviously the preferred investors want to maintain their level of control in their directorship seat there. And then walking through, there's some other key venture financing terms, which are in the term sheet and which are in the various venture financing documents. They're anti-dilution rights. So these are price-based protections regarding changes in valuation. And Misty's going to speak about this in her segment. There's the co-sell right, which allows you to sell alongside with founders and management and other investors. There's drag-along rights, to force all stockholders to go along with a sale if it meets certain conditions. Like if the investors want to sell and majority of the preferred decide that they want to sell, they can force all of the other stockholders to vote and meet that Delaware law trigger for allowing that sale. There's the right of first refusal, where you have the ability to purchase shares of stock that are put up for sale by founders and management. And then there's the possibility of putting back in place founder vesting. If the founders have been fully vested, if the vesting has lapsed, a lot of investors require that the founder shares require that they have additional investing as an inducement to stay on or meet milestones. And then many different ways that you can do the vesting. There's many different acceleration provisions. You have a choose your own adventure provision there. Other key venture financing terms, preemptive rights. This is the right to participate in future rounds. Calculations can be based on the fully diluted ownership that's market or a percentage of the preferred. There's pay to play, which requires investors to participate at the company's request in a subsequent financing. I don't see this that much, but it does pop up in tech deals, given that there's heavy capital investment to get those products to market and through FDA trials and things like that. There's different information rights that are bargained for, financial statements, right to inspection. There's often kind of like a major investor threshold where if you invest a certain amount of money or own a certain number of shares, for the time that you own that certain number of shares, you're able to put an observer on the board, and you're able to, analyze certain documents, visit the company, check things out, etc. You have lots of information rights. And then there's registration rights in the event of an IPO, and then market standoff agreement, so that you agree that your shares will be locked up after the initial public offering. So we've gone through a lot. All of those terms are negotiable. The time to negotiate them is at the term sheet phase. If you do that, you can set yourself up for success in the future. The terms that you agree to in early rounds can impact future rounds, because preferred rights can impact the ability to make business decisions without investor support. You might find yourself always courting investor support. If you have an investor board, that might make that even more difficult. It's easier to add preferences than to take away preferences in future rounds. And the documents will naturally be rolled forward containing the same major terms in the future. If one investor sees a term that they like, that they've had in the past, they'll see that in diligence and they'll want that term back, even if that term went away. Be very mindful of the voting thresholds for approvals required in different documents, and be very mindful of communications with your investors and who you have on board to get certain approvals, and who you might have to court a little bit. But hopefully this gives you a lot of information on, how good steps early on and understanding the documents early on, even in the note safe stage, will set up your company for success in the future. And then I have a little gift for you, a 30-minute free initial legal consultation. You can schedule it on my Calendly. If you want to chat with me more, I know I've kind of probably hit everything way too hard, but it was great speaking with you. I'll stop sharing.
Okay, Catherine, thank you so much. So if you are all feeling a little bit overwhelmed, that's okay. Nobody's supposed to figure this out in 45 minutes. It takes a long time to get this right. And if you're walking away from this part of the session and feeling like you change your answer on that first question about what's the thing you're now most concerned about, and now it's valuation, that's probably a good thing. So we see valuations be the thing that hangs up more deals than probably anything else. So if the valuation is wrong, it can be really detrimental to your business. Catherine Edmonds, thank you so much for joining us tonight. We're so grateful to have you here to jump in and do this piece for us. Catherine is going to stay on to do the Q&A at the end too. And again, if you have questions about this, this is one of those items that the team at the Brink or some of the other accelerators in town can help you get through this process. So I'm going to, right after the break, I'm going to share probably a bit more elementary view on dilution. And so we're going to go ahead and jump to the break. We'll be out for about 5 minutes. So I don't have anything that tells me the time right now. Oh, my clocks are covered up.
6:36.
6:36. So we'll be back at 6:41. So we'll see you at 6:41.
I will say that I hope that you are seeing my screen right now, because my screen's kind of gone crazy.
We are with the
Fantastic.
the quote from Albert.
It's attributed to Albert. I don't know if he's ever actually said the quotes that are attributed to him, but I like it nonetheless. The quote is, "Everything that can be counted does not necessarily count. Everything that counts cannot necessarily be counted."
Here, here.
Definitely worth considering thinking about valuation.
So valuation wise, I found out that like a very close competitor is, I think they got 4 million in let's see, February, and then 13.1 in April. So I'm just like, can I work backwards? Christopher, I'm sorry, I'm asking you. Can I work backwards from that and see like what that means toward what the like valuation was, right? Like, so if they got 4 million and then typically you're getting like people are taking like a third, does that mean that their valuation was like in the 12 million at that point? Or like how does that, you know what I mean? Can I guess at what the valuation was?
I think that you could somewhat figure that out, but I don't want to be the person to respond.
Yeah, I mean, I'm
not the best person to call for that.
No worries.
Kelly, this is Jeff. When you tell me which group you're going to, because I'm actually in the same boat. I have other companies that I know how much they've raised.
Yeah.
But I don't know what the valuation is or anything. Like, if there's a rule of thumb that will pass the sniff test, that I can say, oh, these 3 companies raised this much money, and here's the parameters, and here's our technology, and it just like an apples to the truth, as close to an apples to apples comparison. So wherever you go, let me know where you're asking that question, because
Yeah,
that is actually good.
I will. And here's the thing. I'm so glad you said that, because like, I've heard a lot of VCs say lately that valuations are kind of crazy, like high and like whatever. But for this particular case, I looked up the person and I looked up all the information, and it was someone who's like a 13 exit founder. Like, this is somebody who could probably make a couple phone calls and get that kind of money. But at the same time, he did get outside capital. So it wasn't just him putting in, you know what I mean? So yeah. I think he could have raised quickly and gotten more based on that. So does that, but tech wise, he's like at the same place. So
where did you go? Was there any place that you went to go find that? Was it that? Because I wonder if I can go look at the same place you did.
I was just asking around, like
Okay.
rule of thumb. I was asking like some VCs and angels, kind of like, usually what does it look like? How much of your company should you expect to give up? Like for what?
Yeah, so
So
I guess asking the question differently. How did you find the other companies and what they raised?
Oh, that was on Crunchbase. Sorry.
Okay.
Yeah.
That's what I was wondering. Okay. It was on
Yeah.
Do you have the paid subscription for Crunchbase, or did you find it just
I actually don't. I would love to, but I haven't found the need to do that quite yet.
Yeah. I wonder if the Brink has access to that we can go into.
That's kind of what I was wondering. There was someone on here not long ago was talking about having access to something. I think from Makina, Karin, she may have followed up with them. I cannot remember. It's a long day, but yeah. So I think there are some people we can ask.
Yeah, I asked about. Hi, I'm
Hey,
so
Karin.
tired. It's been such a long day.
It has. I'm with you.
I'm like, oh, that was a really good presentation. But even as a lawyer, I'm like, there's a lot of, stuff for me to think about. But anyway, so I have a call with the Brink on Friday, and I'm going to ask about PitchBook, right?
Yeah.
Kind of
PitchBook is what it was. That's right. Yeah.
Yeah. Take a look at what the other companies that are in our space have pitched, and like what they raised and how they raised it. So, and now I have 4 MBA students at the University of Colorado helping me with this funding project right now. Yay, I know. I've spent so much time trying to get all of the stuff to them. But anyway, yeah, we're just trying to figure out like why it's so hard. The whole original project was around funding and women getting funding, Kelly.
Right. Yeah.
Right. So I think they're just approaching it holistically. I don't think they're looking at it because there are 3 dudes and a gal that are working on this with me.
Yep.
Anyway, it should be interesting. I'll share with you what I can.
Yeah, I'm wondering if, to your point, Jeff, if there's a handful of us looking for somewhat similar access or information, if we can kind of connect and make that happen. I know Misty was mentioning like some of the library stuff, but yeah, maybe if we check in on the Slack channel. Are you guys on the Slack channel?
I don't know if I'm on the San Diego Angel Slack channel.
No, Kelly, are we
Just-
connected on LinkedIn? I forget if we are. I'm looking right
Yes,
now.
we are.
Okay.
I know
If-
Kelly
if-
and I are. I would go in on it with you guys if it. I just don't want to spend that much money.
Agreed. We're bootstrapping, same. Like it is. If we can get the information without having to like commit to like, being a full-on company, but we don't need that yet, so
Yeah.
Right.
Misty.
All right, I'm gonna draw.
sorry.
I heard the mention about PitchBook.
Oh.
The Brink doesn't have access to PitchBook. I would love to have access to PitchBook. It's not affordable for us either. What we do have though is we have a new unit at USD. It's a master's level program called the Masters of Business Data Analytics. And I don't know if Diana's still on. She might be able to share a little bit more about that. But that group has access to a lot more tools, and they've got some support and training around those kinds of things. They're looking for great class projects. So they're not looking for, hey, can you go look up this one number for me? But they're looking for actual projects that they can dig into. And then we're building a new School of Business building. So right now we're spread across 10 different buildings on USD's campus. And we'll go from our 38,000 square feet to 160,000 square feet next summer. And there are three things you should care about. One, we have major space dedicated to our programs in that building. So FEI, Brink, something we're going to call the Collaboratory, lots of innovation entrepreneurship programs there. The other two things you should care about in that building are a finance lab and the data analytics lab. And those two locations are going to be places that have all kinds of resources. That building is construction scheduled to finish in August. Right now they're running ahead of schedule. We could be in as early as June. So something you never hear in construction, like on time, ahead of schedule, and on budget. Super exciting. But those that's not super helpful to you in the next 7 or 8 months, but it's coming. We're headed that way.
Misty, as a USD alum, do we have access to that?
As a UCSD alum?
As USD, San Diego.
Oh, as a USD alum? Yes. So
Okay.
in fact, there's a dedicated space for alumni to come to the building and just have a place to work.
Okay.
So there are some resources. And for everybody else, if you're affiliated with the Brink or San Diego Angel Conference, it'll be available to you as well. So, I hope we can do something extra for alumni. It feels like that's something we should be able to.
Misty,
Yes.
how about if my daughter is an alum? Would that qualify me?
Yes. Mhm.
Great.
So we, parents of students, we treat, with some grace because you footed the bill. And for the most part, like almost all parents are making some contribution to their kids' college education. So
All right. Thank you.
anyway, those resources are coming. We don't have them all lined up quite yet. The
Understood.
library at UCSD has more of that. I don't know if they have access to PitchBook, but it's it would be on our short list of first big data that we would be purchasing. And if you've got a project that's big enough, those data analytics students it's a new program and we don't have a good funnel for that kind of stuff yet. So I would love to fill their pipeline with startup projects, not big corporate projects, because I lean that way. So I want to bring us back to tonight. Well, I guess I don't really. I want to go back to last week. I got some feedback from last week's session that the speaker was fantastic, but people were really hoping to be able to get information about just how to build some basic business structures, some basic financial structures. So how do you put some things together that help you get to a good forecast and some of those kinds of things. So I do think we are going to bring back a speaker that we had last year who did a really nice job for us. He and I are working on figuring out how to get him into the schedule. Am I still sharing? Do you guys see now a spreadsheet? Or do you still see slides? You see the spreadsheet?
Spreadsheet.
Yes,
Okay.
spreadsheet.
So Chris is going to drop the link to this spreadsheet into the chat. This is the tool that I used before QuickBooks was a thing. And I hate to think that I got old enough that I can say things like that, but turns out I can say things like that. To me, this is still one of the best tools around if you're trying to really fundamentally understand what happens on the finance side of the business. So this is angel investing aside. This is just business basic kinds of things. And what I love about this is you should download it and then you should make a copy of it and keep a pure, clean copy, because you can mess up things in this, but if you can figure out where you messed them up, you can usually fix the things. So I just want to walk you through just a little bit of this tool, because I think this could be very helpful to a lot of you, and it starts to help to, with the understanding of how some of the different reports are useful and what investors are looking at. This one will also build a 3-year pro forma for you. So this is a, you can make this into a forecasting tool, and you can also, because it's a spreadsheet, you can customize it. So there's a couple of things, yellow boxes. You fill in yellow boxes, you don't touch green boxes. So don't touch the green cells. Those cells are all formula based. And it starts with simple things that we know, like, hey, what's the name of the company, right? So then you just follow the tabs across and the tabs build together. So you can go in, and this is set up so that you can do it as a startup. Or if you have an existing business, you could come in and you can drop data here that's going to build into those forecasting tools further down the road. So it's going to, and there's instructions. Instructions are usually in red. And again, don't put things in the green, put things in the yellow boxes. So I like that it's ultra simple. And you'll see the date on this. So I've been using it since 2011. It was developed, it had been around quite a while before I started using it. So it's this is a really old school tool. You can go through and you just start filling in these boxes, and then it's going to automatically calculate things. And then you can go make adjustments based on what your needs are. So salary information, fixed expenses, sales forecasting information. There's a couple of those different ones. So these sales forecasting information, there's pathway to build 4 products in that, right? So it's not super like robust, but again, this is a tool that you can dump all the same stuff into QuickBooks. What I like about this is you can see how the things affect each other as you as it flows through and builds the reports. So if you keep just following the tabs over, it'll create a beginning balance sheet for you. It'll create a P&L or income statement. Those are the same thing. It was something I didn't understand until I was in business school. It'll build a cash flow statement. And then if you just keep clicking over, it will actually build those forecasts. So, and it can be, it's fairly complex. And worth a couple of hours of plugging in information just to see how some of the things work. So this, again, this isn't what you put in your deck. Investors don't want to see that. At some point, they might want to see this level of detail, but initially they're not going to want to see this level of detail. This is just a tool for you. Feel free to download it from the folder. I think Chris set it to view only, to keep people from accidentally, like, we don't want anybody to put their data in there, and then we'll share it with everyone. But I did want to make sure that I got this information to you. So hopefully this is helpful on a follow-up from last week. So, all right, did I go back to my PowerPoint? Okay, any questions on that?
Looks like there's one in the chat, Misty. How do we download it?
Oh,
Go to the upper left hand of the file.
yeah. So if you click the word file, and you just look down that list, download should be one of the options. So if it doesn't work that way, then Chris or somebody's gonna have to say it, because I
don't see download. I see make a copy.
let me see.
Do you have
Oh,
Excel? loaded up?
I have it downloaded. I'm not looking at it from the file.
I lied. It's actually there.
It is there? Okay, good. Some things you do so often that you don't know, like, I don't know where I turn to go home either. I don't know what the name of that street is. So things I do too often that I no longer think about. All right, so I have a quick set of slides for you. We won't spend a lot of time on this because I want to get to the breakout sessions. I know everybody's got a lot of questions. I just have this short piece on dilution. And I think this is just helpful. So when a lot of times working with early stage startups, they're really sincere concerns around loss of control and, you know, some of those kinds of things. So again, we talked about valuation, the pre-money and the post. So pre-money is what the company's worth before the investment. Post-money valuation just means that it's the pre-money valuation plus whatever's now been invested. That's your post-money valuation. So, and I like the gold bars because to me, it's how entrepreneurs view their companies, right? Like, so we look at it and like, you know, what's it really worth? And we think it's more like this. And then investors take a look and this is what they see, right? So this ends up being a major negotiating place and a lot of emotion tied up in here. You know, I had somebody tell me in the last week, they have $1 million of their own sweat equity in a company. Thanks, that's a lot, right? That's going to get discounted by investors. And there's no perfect answer. Much easier to figure out the valuation once you're in revenue and you have plenty of sales under your belt and you've proven out the market opportunity is real and you've got traction. It's a much easier game, but this early stage, it is why we see the convertible note so often, because it allows us to sort of put that valuation, you know, the really tight defined valuation on hold for a little bit. All right, so I have to do things that are simple. So this is my lemonade stand argument. And so I'm going to walk you through the scenario just real quickly. We're going to imagine that we're a kid and we're launching a lemonade stand, but we're launching it in Silicon Valley or maybe in the tech center of San Diego. And so I'm going to play with much simpler numbers to just try and keep the illustration easy without anybody having to try and figure out the math. So I'm going to suggest that even though when we see authorized stock, we're usually seeing millions of shares authorized. For our example, I'm just going to use 1,000. And then the founder stock, because I'm the founder and you know my family owns the lemon tree. I'm going to take the first 80 shares. And so of the authorized stock, I'm taking 80 shares and I now have 100% control of the shares that have been moved, not just authorized, but actually the moved shares. And let's say that there's a kid down the street whose dad's a carpenter and has a much better stand than I have. And they want to come in as my first investor. And they're going to take 20 shares. So this is pretty simple, right? So they own 20%, I own 80%. We still have all of those, 9,900 authorized shares that we're not touching yet. And for our little baby example here, we're going to say $1.
900.
So for
Misty, sorry. Should
yeah,
there be an extra zero after those 80 and 20 shares? Since
No.
we're starting with 1,000?
So that's the interesting point. You authorize the shares, but you don't move all the shares at once, right? Because then you wouldn't have any room to create an options pool or bring on another investor. Those authorized shares just sit there. They're just on paper. Lawyers can tell you the more detailed, but you actually end up with a lot of authorized shares that are sitting there that aren't executed.
Okay, so.
This is
so there's no-
actually accurate.
Okay, so there's 900 shares that are not executed. Is that what I understand correctly?
There are 900 shares that are not executed.
Okay, thank you.
All right, so if this is the case and the shares are valued at $1, then it looks more like this. 91% of our shares are authorized but not executed. 2% of the shares are held in preferred stock by a first investor, and 7% of the shares are held by the founder. Founders always get common stock. So founder stock, common stock, those are synonyms. You can treat them the same. Again, maybe somebody who does this really to the next level is going to tell you that there are some differences, but I'm going to suggest for our purposes, they're pretty minor. And so this is what we've laid out for ourselves. So so let's say that the valuation is $1,000 and we're going to sell the company. So based on this, the investor is going to get 20%, $200, and the founder is going to get 80% or $800 if we sell the company for $1,000. If, however, the valuation of the company is $500 and we sell the company, then the investor, because they have preferred stock, they're still going to get 200. Doesn't matter. They still get the 200, and the founder will get what's left over, 300. But if we sell for a lot more, right? So the example of $1,000 valuation is even. It comes out exactly like you imagine it will. A $500 valuation comes up short, and there's a winner and a loser here. And then if, let's say we have our little unicorn lemon stand and we sell it for $25,000, what we do is we take the preferred stock off the top, 200 comes off the top. So we're dealing with $24,800. And then we multiply the 24,800 times 20%, and we come up with 4,960. So the investor gets the 4,960 plus the 200, and their total take would be $5,160, and the founder would get close to 20. So that's kind of how, in the simplest format, 3 examples of valuations that could happen in a sale of a company. It could look a little bit like that. All right. So just to recap. On day 1, there's no dilution. The founder owns 100%. You bring on the first investor, and the ownership or the control starts to change a little bit. So let's say we bring on a key hire. So this would be an options pool for, I don't know, maybe we've got a neighbor who's got another lemon tree, or an agave plant, or they're in the house on the next block and we get to open a branch, right, for our lemonade stand. So we're going to have some shares that we're going to hold aside for that key hire. And then it kind of goes like that as you go through different investment rounds. So you take a second angel investor, maybe in a real life example, this might be the place where you're taking the seed stage. And so the ownership or the control continues to change. So in this model, the second angel investor now 15%, and the founder still has 62%. And then what we normally see happen is the venture capitalists come in, and they come in with big money, and they do have an expectation of taking more control. And so you start to see that change. So a lot of times it's bigger than a 28% share. It could be, could cross the line and change the control of management.
So Misty,
Yeah.
2 questions. One is, you're assuming all common stock until the first venture round?
This is actually assuming that the founder takes common stock. And well, this is an ultra simple example, so it's not really addressing some of those things. In my mind, usually the The founder's always gonna take common stock. Almost always key hires are gonna take common stock. And then investors are gonna require preferred stock. And again, back to Catherine's information, the preferred shares can come in a lot of ways. It can be, preference and liquidity, or it can be, you can tack on lots of things to what it means to have a preferred share.
Okay, and then the second question is that to protect the control of the company, if the founders want to protect the control of the company, you had them not with a majority percentage of the stock, which I understand can send a bad message to investors. Right, so what did the founders start out with in terms of not only unvested shares, perhaps?
Right, so this isn't dealing with vesting at all, because it's a really elementary, it's intended to be elementary and keep the focus pretty simple here. In this example, the founder had 100% control when they took the first 80 shares. So the control continues to change as you take on additional investment.
Correct.
Right. So I don't know if there's a more question there. I missed it.
Well, I was always told that if founders vested over something like 4 years, it would send a good message to investors that they were in it for the long haul. And so at any point that you bring in new investment, you're rejiggering the percentage that people actually own, right? So at some point you would cross the line and potentially lose control unless you had allocated a significant amount of stock to the owners. Is that correct or not?
That's correct. So in that, that happens a lot. I actually have some, I think, fun and really honest examples of some of that in a couple more slides. All right, so what does it all mean? So in our example, if we sold the company for $25,000, this would be how it would play out. So the founder would end up with 11,000, the VC would end up with 7,000, and so on. Right. So this is sort of how it shakes out. And is that good or bad? Well, if all of us could afford to scale a company and really take it to where its potential is without taking on investment, that's definitely the best way to go. But most of us are not in a position where we can fund the inventory or fund the marketing that's necessary to really scale a growth-oriented company. So that's why we end up talking about angel investment at all. Angel investment also gives us the ability to bring in, key advisors and additional insights and get out of, trying to do everything ourselves. So, there's some good reasons to do that. But probably the biggest reason why you take on angel investment is what it means for your ability to grow the company and the profitability and the long-term returns for your family and for the people that you employ. So this is just one more way to look at the exact same information. And this is how the ownership would change. This is how the control would change over a series of rounds. And if you had, more rounds than this or any, you can change any of these variables and it would impact, all of those percentages. But the important part is you want to take on investment because 1% of a lot is a whole lot more than 100% of nothing, right? So that's the best way I've ever seen it put, was just that way. So I have a quiz for you. You guys know who this guy is? Turn your mics on, let's shout it out. I think this is, somebody's gotta know.
Jeff Bezos.
Woohoo! David wins a candy bar. I'll get you one the next time I see you.
And mail it. I'm kidding.
Put it in the, I'll do that. Anybody want to guess how much he owns of Amazon? How much does Jeff Bezos?
10%.
Yeah, just over 10%.
Wow.
And don't go Google this. Like, this is easy number. The unit with any public company. Okay, next one. Come on, everybody knows who this guy is.
Mark Zuckerberg.
Zuckerberg, right? So how much does Mark Zuckerberg own of Facebook? Anybody want to take a guess?
It was 51%, but I'm not sure where his shareholding is now.
It's a lot more
Oh, 14.
expected.
Wow.
Yeah, so he's actually moved a lot of the asset after the IPO. He's taken a lot of his money out of his own company. So one more.
So Misty, this may be a dumb question, but how come he maintains so much control then?
Well, so that's a good question for both Jeff Bezos or the Zuck. Both of them, this is still a huge controlling interest in the company. Huge controlling interest. After an IPO and you're publicly traded on the stock market and whatever, everybody's, can buy a little piece of your company. And it's really hard. It would be very hard for anybody to get 5 or 6% of either of those behemoth companies, right? They're both valued at like billions of dollars. So to buy that out would be tough. I have two more.
Misty, there's
This guy.
another, sorry to interrupt. There's another
Yeah.
really important point is that he still retains a majority of the voting shares in Facebook.
I read that too. He retains the voting of the majority of the voting.
And I don't know
shares.
what that percentage is, but I think that still holds today.
Well, and that's part of the structural documents, right? So as you put things together and you define your policies and some of those kinds of things, it's important to get that right. I've seen it go the other way also.
Yep.
Where
Yep.
somebody founds a company, grows a company, ends up losing control because they didn't have their documents set up. They don't have the right protections in place. So I'm saying this to all of you because wow. Okay,
Yeah, I think
everybody knows who this guy is. So it's Bill Gates. How much does Bill Gates own of Microsoft? Anybody want to take a guess?
Percent?
As a percent.
Probably 5% now. It's probably very minimal, I bet. So,
He owns just over 1%.
just over 1%.
Right,
So
just
1.3, yeah.
1.3%. So, okay, last one. Who knows who this is?
Is that
Blakely?
yeah, Blakely.
Yeah, that's right. It's Sarah Blakely, the owner of Spanx. How much of Spanx does Sarah Blakely still own?
She just sold it today.
She's now my worst example. She was my best example.
Yeah, Blackstone.
Oh, wow. Fantastic.
Most of it. I don't know.
Well, does
'cause I
anybody want to
forgot
guess
read the
how much
rest.
she owned yesterday?
I bet it was actually fairly large, 25%.
All of it.
Yeah, I was gonna say all of it. She said she hadn't raised any outside capital.
Yeah. So
Wow.
until I guess today, Spanx was privately held.
Yep.
Took on angel investors. She never took on venture capital. And like this, if you could do it, great. She maintained control all the way to the very end. Super unlikely, but I'm going to give her a shout out because it's Women's Entrepreneurship Week, and I don't generally care too much about gender business at all. But I thought this was like a shining example of like, what you can have happen.
Yeah.
She did have some other things going for her, like she had really tight IP and nobody else playing in this, and she owned the brand. She owned the whole space. So sort of like launching something new and becoming the Kleenex of tissues, right? So good job, Sarah Blakely. All right, so with that, if there are questions, happy to entertain some questions. I hope that my little elementary example is helpful to you. And then does anybody have any questions? Anybody?
So it's have enough voting right. I mean, you could have 51% voting rights and still own, say, 40% of the company, of the shares.
Yeah,
That's right, because there are different classes of shares. And in some cases, in Facebook's case, they have voting and non-voting shares, both. Not
Oh,
every
yeah.
company does that, but
is that typically set up in the very beginning, or is that set later on, or how?
That sounds like a Catherine question to me. Catherine.
I don't know when that was set up at Facebook particularly, but I do know that Facebook had a lot of shareholders at the very beginning, so much that they had to go backdoor public and kind of screwed that up, that they didn't get the chance to have an IPO really, because they had too many shareholders at the offset, and they were de facto public and had all the reporting requirements. So I would be inclined to think that this was set up early, because it seems like they had a lot of shareholders early on, which is not something that you generally see. So it makes sense to have two classes.
I think Snap did the same thing. I forget the guy's name, but he did that. He had controlling rights. Not that helps answer my question how they set it up. So
Misty, a question. In your scenario, you didn't assume the value of the company increase, you understand, right? Through the multiple rounds. But isn't that each round the value increase? You actually sell a smaller chunk of the company needed to raise the same amount of money in the value increase, especially with future inflection.
Yes.
Is that what reduce your dilution? I mean,
Right.
That's what strive for, right? That's what entrepreneurs strive for.
Yeah, no, I think if I tried to build a very accurate example, it would be very hard to do in a simplistic way. So like you're completely correct. The valuation would change at every, there would be sets of milestones that you'd hit. You'd be raising for next milestones and mitigation of risks. So all of those things would make a big difference. So for the purpose of the illustration though, I just kept it really, really simple.